Hi, welcome to Accounting 301, Week 2. Uh, this is Chapter 3. So hopefully you look through the Chapter 2 material as the Chapter 3 material sort of builds on that. So we're going to talk in this chapter about, it's called the Accounting Information System, but really what we're going to be covering is the accounting cycle. So we're going to first look at some basic terminology. Some of this you're probably familiar with if you went through the Chapter 0 information. General ledger, general journal, subsidiary ledgers, trial balances, those types of things, the basic terminology. We're going to look at how debits and credits work. Hopefully that'll be a review for you, but if you haven't picked that up yet 100%, really pay close attention because you're going to need the rules of debits and credits for 301, 302, 504, 341. So you're going to use it in all your classes. So it's a tool, something in your toolkit that you need to be very familiar with. We'll look at the accounting equation. You're familiar with that: assets, right, equal liabilities plus equity. How to prepare financial statements, different ownership structures that we have, and we'll have different types of financial statements if we have different ownership structures, for instance, a corporation versus a sole proprietorship. All right, and then we'll look at the accounting cycle. I really like to think this whole thing is really the accounting cycle, everything that we're talking about in this chapter, and it used to be called, the chapter actually did used to be called the accounting cycle. Within the accounting cycle, we're going to look at journalizing, book of original entries. So we're going to look at making entries in sales journals, so forth, posting to subsidiary ledgers. Posting just means copying. And then preparing a trial balance. So once you prepare your general ledger, I might be getting ahead of ourselves here, but once you prepare the general ledger, you want to, outside, I guess, of computer environment, you want to have assurance that the debits equal credits. The reason for the trial balance is to see that your debits do equal your credits and that there's hopefully no mistakes in your processing of your transactions. All right, and then adjusting entries. There's typical types of adjusting entries: deferrals, which would be prepaids and unearned revenue; accruals, like for accrued interest or accrued salaries. And then we'll look at the adjusted trial balance. And the adjusted trial balance, don't be confused by that. It's just your trial balance, and then we add the adjusting entries. Then we'll go ahead and prepare our financial statements, first making our closing entries. And I don't know if you remember this, but the closing entries, of course, are for your income statement, or what we call nominal accounts. Post-closing trial balance, we'll look at reversing entries in brief, and then we'll look at our financial statements, and we're going to look at a merchandiser as an example. All right, so here are some questions that management might have. What kind of debt is outstanding? Were sales higher this period than last period? What assets do we have? What are our cash inflows, outflows? What were our profits? What product lines are doing the best and the worst? Can we increase our dividends? And is our rate of return on net assets increasing or decreasing? These are all questions that you would find, hopefully, in your financial accounting information system. All right, so just a real quick question here. Just quick one question quiz. Factors that shape an accounting information system include all these, right? Nature of the business, size of the firm, volume of data to be handled. All these choices are correct with respect to an accounting information system. So basic terminology: an event. And I'd like to compare an event with a transaction. A transaction is normally going to be financial, and it's going to be something that's going to be entered into the books, right, into the journals and ledgers. An event, though, is something that happens that you might want to record, but you may not necessarily record it in your accounting information system. For instance, if I, pick inventory, right? If I pick inventory from the warehouse, that's an event. Probably not something that's going to hit the financial statements, but it is something I want to keep track of because I want to know what inventory has been picked from my warehouse and what hasn't. An account, okay, is a general ledger account, cash, account receivable, inventory. All those are examples of account. Some accounts are real, some are nominal. In general, real accounts are balance sheet accounts. nominal accounts or income statement accounts, nominal accounts are closed at the end of the year. Right? Closing entries are made for nominal accounts. The general ledger holds all of your accounts. It's going to be easier to show this, I think, as a picture, and we'll do that in a minute. The journal is where we originally record our transaction. Some of you may have used QuickBooks. You'll notice QuickBooks really doesn't use accounting journals other than the general journal for adjusting entries. The QuickBooks will have you enter information into forms. So, for instance, you might write a check, say for $37, right? You write a check. That would be entered into the checkbook, and the checkbook would automatically, when you enter into a checkbook, it would automatically enter it into what they call a journal behind the scenes. So in effect, I really don't. It's QuickBooks really is built on a database. So it's really not, it is double entry accounting, or at least it looks like double entry accounting. You have to know double entry accounting to use QuickBooks, but it's really, the manufacturing of it is really on top of a database. Posting is just posting from the journal to the ledger, just copying amounts from the journal to either the subsidiary ledger or the general ledger. Of course, in a computerized environment, that would be done automatically. Trial balance is showing whether all our debits equal our credits. We can do that in a worksheet. We'll show that in a few minutes. And then I think you did in chapter 0, right? You did, if you did the chapter 0 work, you did do a trial balance for me. Adjusting entries, we may have to adjust the books for things, for transactions that occur that we didn't record. For instance, we earn interest on our bank account. So we're not recording that every minute I earn interest and I can record it. It doesn't make any sense, right? Cost benefit. It doesn't make any sense for me to do that. But at the end of the period, I do want to adjust my interest revenue account and interest receivable account for the amount of interest that was credited to my bank account. Financial statements, so we'll look at the preparation of those, particularly for a merchandiser, and then we'll look at closing entries, where we close out our nominal accounts or income statement accounts. So we can start at 0 for the next year. All right, so process of transferring figures from the book of original entry to the ledger account, I just mentioned that is called posting. All right, so debits and credits. All right, let's take a look at this. So we have an account, and the way that we change the account is by either debiting it or crediting. Now, debit and credit just mean left and right. So it's going to depend on what account you have and the balance of that account as to whether a debit increases or decreases that account. Simple example, cash, right? Cash has a debit balance, so it's going to be increased by debits. So anytime I received a check for $100 from a customer, I'm going to debit cash for 100, probably credit accounts receivable for 100. All right, so debit just means left side, credit just means right side, but they can mean increases and decreases depending on the balance of that account. So a cash account with a debit balance will be increased by debits, will be decreased by credits. This is a T account form, so this is basically showing the general ledger. You can imagine that's cash, that we'd have a debit balance in that account. So debit always means the left side of an account. So none of those are correct. All right. So if the debits are greater than the sum of credits, then the account has a debit balance. So this might be the cash account. In transaction 1, I received $10,000 in cash from a customer. Transaction 2, I paid $3,000 of cash to a supplier. Transaction 3, I got another $8,000 in cash from a customer. So I got total inflows of 18 and outflows of 3. So my balance, this is the cash count, would be $15,000. All right. On the other hand, an account with a credit balance would be a good example of the accounts payable. Here, credits increase the account. So let's say I paid off an accounts payable, transaction 1, so I debit accounts payable for $10,000, credit cash for $10,000. Transaction 2, I buy some supplies on account from a supplier, so I debit supplies and credit accounts payable for $3,000. So by crediting accounts payable, I'm increasing the amount in the accounts payable account. Third entry, I buy some more supplies for $8,000. So debit supplies, credit accounts payable for $8,000. So notice that the credits are what's increasing that account. All right, so normal balance for asset accounts such as cash, accounts receivable, inventory, prepaids would be a debit account. If an asset account does not have a debit balance, it's called a contra asset account. An example of that would be accumulated depreciation. All right, expenses also have debit balances, so they're increased by debits and decreased by credits. Liabilities, on the other hand, have a credit balance, so of course are increased by credits and decreased by debits. Liabilities, stockholders' equity, revenues are all the types of accounts that have credit balances. So here's a summary. If a asset has a debit balance, it's going to be increased by debits and decreased by credits. Liability with a credit balance is decreased by debits, increased by credits. Equity, same as liability. Revenue, same as equity. And then expense will be the same as assets. All right, so I think the most important thing about debits and credits, know what the balance is of that account. That's going to tell you whether debits increase the account or decrease the account, or whether credits increase the account or decrease the account. You remember the accounting equation, probably from Accounting 201, is simply assets equal liabilities plus equity. After every equation that we make, after every transaction that we make, the balance must be in balance. Debits must equal credits. So whenever you make a journal entry, within that one journal entry, debits are going to equal credits. Okay, so anytime I make a transaction, if I, for instance, buy supplies on account, supplies has a debit balance, right? So I'm going to increase the debit here. Buy it on account means accounts payable. So I'm going to increase the credit here. So it's like $100. So I got $100 increase to debit here and $100 increase to credit here. Any transaction that you make after the transaction, debits are going to equal credits. Debits must equal credits. Here is another way to look at the accounting equation. And the answer on this is D, assets minus liabilities minus owner's equity must equal 0. So in other words, assets equal liabilities plus equity, right? So assets minus liabilities and minus equity has to equal 0. Accounting equation must remain in balance. Which of those is true? Obviously, throughout each step in the accounting cycle. So every time I make a transaction, that the accounting equation must be in balance, but also as I go through and process my post to my ledger, debits must equal credits. When I do my trial balance, debits must equal credits. When I prepare my financials, debits must equal credits. So every step throughout the accounting cycle, the accounting equation, assets must equal liabilities plus equity. Have different types of ownership structure, right, for companies. So that dictates type of accounts that are part of the equity section. If you're a proprietorship or a partnership, you may remember these accounts. Owner's capital, which is similar to retained earnings, for the owner's account for a corporation, and then owner's drawing, which would be similar to dividends. For a corporation, common stock would represent your shareholders' ownership in the corporation. Paid-in capital in excess of par, if they bought, which they probably did, the common stock at a price higher than par, you're going to have paid-in capital in excess of par. Not to worry about this one until accounting 302. Dividends, if I pay out dividends, that has a debit balance. That's going to decrease my owner's equity, and retained earnings could decrease or increase whether or not I have net income or a net loss. All right, so here's just an overview of the financials for a corporation. So a balance sheet within that stockholders' equity section, they're going to have a common stock section. retained earnings, dividends, and net income or loss. The net income or loss, of course, is going to affect your retained earnings. Will be increased if we have a net income. Dividends as well affect retained earnings. We're going to close out the dividends account. And when you close out the dividends account, you close it out not to what we call income summary, but it's closed out directly to retained earnings, where sales, revenue, and expense accounts would be closed out to income summary, and then income summary would be closed out to retained earnings. All right, this is just an overview of the accounting cycle. So we start with the transaction. It just might be some paper. Here's a receipt. Journalize this. Oh, okay, I received cash for $100 from a customer. He's paying off a receivable. We post it to the ledger and the subsidiary ledger. So we post it to, and we'll show this in a minute, but we post it to the customer's name in the subsidiary account receivable subsidiary ledger. And then we must also post it to the general ledger account, cash and account receivable. Once we're done posting, done all our posting to the general ledger, then we'll prepare our trial balance. We'll make adjusting entries. We could use a worksheet for that. We don't have to. We'll prepare an adjusted trial balance, financial statements, closing entries, post-closing trial balance, and then if you do reversing entries, that'll be the last step before you start the accounting cycle again for the next period. All right, an optional step in the accounting cycle is preparation of post-closing trial balance. So the post-closing trial balance is not needed. It's basically going to be your balance sheet. It's going to be what real accounts that you have left. We'll have your updated retained earnings. I'll have you do, if you take my accounting 341, also the other professor, Dr. Tapas, if you take the 341, you will prepare post-closing trial balance in that course, as we'll do a worksheet. We'll do a manual system worksheet. All right, identifying and records. So, excuse me, FASB uses the phrase transactions and other events and circumstances that affect a business enterprise. So transactions can be external, meaning it's between the entity and the environment. So a transaction between us and a customer would be external. Internal is a transaction that occurs entirely within an entity, within the company. So if I'm paying my employees their wages, that would be an internal transaction. Cost accounting transactions like work in process, finished goods, raw materials, those entries to finished goods, particularly to finished goods and work in process, those would be internal transactions. They happen within the firm, that there's nothing going outside the firm when I'm updating work in process to finished goods. An example of an internal transaction would be paying salaries to company employees. All these others would be external transactions. Journalizing, a chronological record of transactions. Journals are recorded in the journal. So we're going to show a bunch of journal entries here. First one is stockholders invest $15,000 cash in the corporation. So we're going to debit cash because it's increasing cash. Cash has a debit balance. So increase cash by $15,000 and increase common stock. Common stock has a credit balance. And so that must be credited to increase it by $15,000. Then I bought some equipment for $7,000 in cash. So that increases the asset equipment by $7,000 and decreases cash by $7,000. Note that after I do each of these transactions, right, debits still equal credits. All right, then I can post from the general ledger to the from general journal to the general ledger. So some of these things you might not be familiar with. So we posted on September 1st. The transaction was September 1st. We're going to do the posting on the same date. As I mentioned, more than likely, if you're using a computerized environment, all this information is going to be done automatically once you make your journal entry. These are post-reference accounts. So these are the ways I can trace from the journal to the ledger. So cash is account number 101. So I can trace that here. Common stock is account number 311. So I can trace that down here. I can also trace from the ledger back to the general journal using the page number of the general journal. So we have general journal, or it's just journal page 1, J1. So we're seeing here, right? General journal says J1 here, and that's simply a way to trace from the ledger back to the journal. All right, and then we're going to post our amounts. So cash now has a balance of 15,000, and common stock has a balance of 15,000. All right. So here's a posting of first a journal entry of cash increased by 100,000, and common stock increased by 100,000 because we had stockholders invest $100,000 in our account. So they invested $100,000 cash into our account. All right, so we debit cash and credit common stock for 100,000. Thank you, shareholders. So cash is increasing by 100,000 because that's a debit balance, right? And then common stock with its credit balance also increases by 100,000. This is just showing a overview of the posting to the general ledger account. So these are T accounts. So this is the way that when you make postings on the exam or on the homework, you can use T accounts. All right, so then I bought equipment for 50,000 using a note payable. So equipment has a debit balance, so I increased that by 50,000, and I increased notes payable by 50,000, as notes payable has a credit balance. Notes payable liability has a credit balance. Equipment, which is an asset, has a debit balance. So increased by debits, increased by credits. Hopefully you're getting the hang of these. We received $12,000 in advance from our Knox client for advertising services that we won't be completing until the end of the year. So this is a liability, right? Unearned service revenue. We are not recording this as revenue yet because it's not revenue. It's unearned revenue. All right, so unearned revenue is a liability increased by credits. Cash, of course, we received 12,000 cash. That is a account with a debit balance increased by debit. So now I have 112,000 in the cash account and 12,000 in the unearned service revenue account. Of course, in this account, normally we'll do an adjusting entry to this, but at the end of the year, we'll note that this unearned service revenue has been earned. So we'll debit unearned service revenue for 12,000, credit revenue for 12,000 at that point. But we don't record revenue until it's been earned. All right, Pioneer Advertising pays 9,000 on rent. So rent expense, debit balance, increased by debits. So right down here, rent expense, $9,000 debit increased. Cash, on the other hand, is being decreased here. I'm paying out cash, running a check, right, for $9,000 in cash, so that's going to be credited. Pioneer Advertising then pays $6,000 for a one-year insurance policy that will expire the next year on September 30th. All right, so we'll debit prepaid insurance and credit cash for $6,000. Sorry, a little bit of noise here. Okay, then next, Pioneer purchases for $25,000 on account 3 months of advertising material, so we'll debit supplies. Credit accounts payable. Supplies is an asset, increased by $25,000. Accounts payable is a liability, increased by $25,000. All right, now this next one, Pioneer Advertising signs a contract with a local newspaper for flyers to be distributed. Pioneer will start working on the contract in November. Payment of $7,000 is due following delivery of the Sunday papers containing the flyer. So no entry is going to be made here because there is no transaction. Okay, just an agreement. This is a contract that we're going to go ahead and perform services in November. But no, since no assets has changed hands at this point, we're not going to record a transaction. All right, we paid a $5,000 dividend to stockholders, so we'll debit dividends and credit cash. Dividends has a debit balance, so it's increased by $5,000. Cash is decreased by $5,000. Employees are paid every 4 weeks. Total payroll is $2,000 per day. Pay period ends on Friday, with salaries and wages of $40,000 being paid. All right, so we have, let's see, $2,000 times 20 days, right? So $40,000 of salaries and wages expense being paid to our employees. So we debit salaries and wages expense for $40,000. It's increased because of debit, and then we decrease cash for $40,000. So debit balance for cash is being decreased by $40,000, so it is credited. All right, and then finally we receive $20,000 in cash, and we bill Copa Company for $72,000 for services that we already performed. All right, so we performed $100,000 in services. We received $28,000 in cash for part of it. $72,000 is going to be collected later, so that's a receivable. Those are both increases to asset accounts, right? AR is a account receivable, is an asset account with a debit balance. Cash is a asset account with a debit balance. All right, and then we credit service revenue for $100,000. All right, and then once my ledger has been complete, I can prepare my trial balance. So all these amounts is $80,000 was the balance in your cash account, $72,000 was the balance in your receivable account, $25,000 was your balance in your supplies account. So all those general ledger accounts I'm going to record here in the trial balance. And this is really my starting point for preparing my financial statements, which you'll see in a second. So we're in luck here. Our debits equal our credits. Adjusting entries, as I mentioned, we have some transactions that occur during the period that we don't record, like interest or prepaids, right? A prepaid, I buy an insurance policy, say for $12,000 in January, and every month it decreases by $1,000. Well, I may not make the adjusting entry until the end of the year when I need to, when I prepare my financial statements. All right, so we want to make sure revenues are recorded in the correct period and expenses are recognized in the correct period. All right, so two types of adjusting entries, deferrals and accruals. Two types of deferrals, prepaids and unearned. And I think you probably did some of these in Accounting 201. And then accrued revenues and accrued expenses. So these are pretty simple journal entries, and we're going to adjusting entries, and we'll do a few of these in a minute here. All right, so a deferral can be either a prepaid or an unearned revenue. If it's a prepaid, it's an asset, right? If it's an unearned revenue, it's a liability. So a prepaid happens if I buy an insurance policy. Let's say I buy it on July 1st for $12,000, and it's going to last a year. So at the end of December, I have used up, right, $6,000 of that prepaid. So I'd have to debit. Well, when I first make the entry, I debit prepaid expense, credit cash for $12,000. But at the end of the period, I'm going to want to adjust that because some of the expenses, $6,000, have been accrued, right? We've accrued $6,000 worth of expenses for the last, part of, for the second half of the year. So I'd have to debit insurance expense and credit prepaid insurance. So increase the expense and reduce the asset. On an unearned revenue, we showed one of those earlier. I received revenues, but I didn't do the work. So let's say December 1st, I received $1,000 in cash for work that's going to be done December 31st. So December 1st, I haven't done the work yet. I'll debit cash and credit unearned revenue, which is a liability for $1,000. At the end of the period, I'll debit unearned revenue and credit revenues for $1,000 to record the earned revenue. All right, so prepaids, the one we normally use for examples are insurance, but supplies, advertising, rent, buildings, equipment, all are considered prepaid expenses. So we'll show some examples. Okay, so Pioneer purchased advertising supplies costing $25,000 on October 5th. The entry would be to debit supplies and credit cash for $25,000, right? That's just the entry. Now, this is not the adjusting entry. This is just the entry to buy the supplies. Okay, supplies has debit balance, increased by debit by $25,000. Cash has a debit balance. We're decreasing it by 25,000. Of course, my debits still equal my credits. All right, so then we count the inventory at the end of the year, or I'm sorry, October 31st, and we have $10,000 left. So what that means is I've used $15,000 of supplies expense, so debit supplies expense for $15,000 and credit supplies for $15,000. All right, and again, I bought $25,000. There's only $10,000 left. That means I used $15,000 of supplies this period. So I debit supplies expense to show the increase in supplies, and credit supplies for $15,000 to show the decrease in supplies. All right, and then on my statement presentation, I've got supplies, assets. They're no longer $25,000, but they're $10,000. And I've got supplies expense of $15,000. So it does affect your financials. When you make those adjusting entries, it does affect your financial statements. All right, and then unearned revenue, where we receive the cash before the revenue. So example, right, I received some cash, $12,000 on October 2nd for KC for advertising, expected to be completed by December 31st. So when I make the first entry, I haven't recorded any, I'm not going to record any revenues because I haven't done any revenues. I'll just debit cash and credit unearned service revenue for $12,000. At the end of the period, though, I have done 1/3. Looks like I've done 1/3 of the revenues. So I'll record $4,000 in revenue. So I'll increase revenue by $4,000 here. And of course, I'll debit the liability account of unearned revenue for $4,000. All right, so my finance statement presentation, I'm going to have a liability of unearned service revenue of $8,000. It was originally $12,000. $4,000 though was earned. And then for service revenues, I'm going to show 106, which includes the $4,000 of revenues that was earned this period. All right, accruals. We have accruals for revenues and our accruals for expenses. The best way to think about this, I think, is with interest. We have accrued interest, we earn interest, or we pay interest. We have accrued expenses. So we have accrued revenues for interest or accrued expenses for interest. Other accounts, though, rent, taxes, salaries, are all accrued entries. All right, so we're going to look at a note. Pioneer Advertising signed a 3-year note for $50,000. The note carries annual interest rate of 12%. So 3 factors determine the amount of the interest, right? Principal times rate times time. And time would be in terms of 1 year. So if I'm just looking for 1 month's worth of interest, right? So I'll take 50,000 times 12% times 1/12. 1/12 months, $500 would be my interest. All right. So on October 31st, I've got $500 of interest that is accrued. So I'll debit interest expense for $500, and I'll credit interest payable for $500. All right, and then my finance statement presentation, I've got $500 of interest expense on the income statement, and I've got $500 of interest payable. So I owe $500, right, to whoever has this bond. So $500 of interest payable on the balance sheet. So adjusting entries are needed primarily for accrued accounting. Accrual accounting. Yeah, they're accruals, and they're needed for accrual accounting. We call it accrual accounting because some transactions are not on a cash basis. Okay, like an account receivable transaction, right? I sell product for $100. I debit account receivable credit sales. It's not a cash basis transaction. But I would record that revenue. I would record that revenue even though I haven't received the cash for it. So that's the difference in the accrual basis accounting gives you much more information than cash basis accounting. Cash basis is still important, and we do a statement of cash flows, but the accrual basis accounting has been shown to give us a much better picture of our financial position. Here's an adjusted trial balance. So what this is, I've just added my adjusting entries to this. So I had an adjusting entry for supplies, right? I debited. So before, the unadjusted trial balance wouldn't have this 10,000 here. It would have 25,000, right? That was a 25,000 we bought for supplies. But we adjusted it. Now the adjusted trial balance, I reduced it for the $15,000 of supplies expense down here. So the supplies went from 25,000 down to 10,000. All right, then we'll go ahead and prepare our financials from the trial balance. Really easy to do this in using a worksheet, but notice that all of this bottom part of the adjusted trial balance becomes my income statement. So starting here with my revenues of 106, everything in red here becomes my income statement. The blue part of retained earnings and net income of 33,000 from my income statement of 33,000 income is part of my retained earnings statement. And then this part up here, you know what this is, right? This between cash and common stock would be my balance sheet. So you can easily prepare my finance statements from this worksheet. It works really well when you have an Excel worksheet. Closing entries is that we just need to remove the income statement accounts. We need to revert those back to zero so we can start over again, right? Income statement is for a period of time, for 12 months. So on January 1st, I want to start with zero. Balance sheet accounts, sometimes called real accounts, are not closed. Dividends are closed directly to retained earnings. So I had dividend of 5,000. I'm just going to close that out and debit retained earnings for 5,000. Okay. Normally, we close out our revenue and expense accounts to income summary. You don't have to. The way they did it here is they close it out directly to retained earnings, which is fine. So I debit revenues for 106. They were credited for 106, so I debit them for 106. Now, for next year, revenue has a balance of zero. And then I credit all my expense accounts for their amounts. For instance, salaries and wages expense at a balance of 46,000. I close that out, so its balance is now zero. So all these expense accounts will now have a balance of zero. Post-closing trial balance basically is your balance sheet. Okay, so these are your real accounts. These are the ones that are left open. All right, so these are your balance sheet accounts that are left open for you. All right, so this is just a summary of what we just did. I'm going to skip the IFRS insights. You can read about those. If you have any questions, please email me or give me a text or call at the number I have listed here. Hey, I thank you for your attention. Sorry for a little bit of noise that we had in this one. Appreciate your attention, and I'll see you in the discussion boards.